Hi, this is Ron Granberg. I am a principal at Clearwater Investment Management, and I'm here to answer questions about finance and investments. Rob, if you have any questions, or I'll take any questions from the phone.
All right. So how's it going today?
Say again?
How are you doing today?
Oh, I'm pretty good.
All right. We got the new setup here. So if you're watching this on YouTube on PANJ TV, it looks pretty cool. We've got the background set up, and you can see me in a little box in the corner. So I think that this might make it a little bit easier for people to follow along on YouTube. So please tune in. So, well, I guess my first comment is that today is May 16th, right?
Yes.
And we were on 2 weeks ago. The market fell 619 points on Monday, and Tuesday, Wednesday, now today it's up about 300 at this point. It's noon on Thursday, and it seems like the entire drop has been brought back to life, and that the market's moving forward. So this seems like it's a great time to invest because I actually wish that I had invested Tuesday when I could have made a quick killing already.
No one can make those calls. This topping sequence is going to be there's going to be enormous plunges, and there's going to be recoveries. Eventually, the recovery will fail to create a 100% retracement. If you look at the volume of the December 26 plunge, there's a lot of selling activity into that decline. And most of the buying activity is occurring near the top here in April and in May. So most of the people that have tried that have gotten in late. During bear markets, you're going to have up days 51% of the time. Historically, bear markets will have more up days than down days. It's just the down days have a larger magnitude, and this is this is the inverse of what happens in a bull market. In a bull market, the market's going to be up 54% of the time, and the magnitude of the increases are going to be larger than the declines. The inverse happens in the bear market. So
you see, it's the market any day in a bull market is up 54%, but in a bear market it's up 51%?
Yep. The up days
so
are...
It's pretty hard to tell them apart then.
The net decline. Over a period of time, the advanced decline line will fall, and the price level of the indexes will fall, and that becomes apparent probably halfway through the bear market.
So what are your observations about the market right now?
We have a euphoria going on. We have Wall Street investment firms, particularly the ones that have underwritten Lyft and Uber, really working to stoke the optimism of principally retirees that are watching television right now, whether they watch CNBC or Bloomberg or wherever else they get their information. Maintaining this lofty level requires a lot of hard work on behalf of the investment management firms.
So this market is basically all about making money. What about the tariffs? Everybody says it's I don't really understand. I mean, on Monday the market flipped out because Trump was going to do Chinese tariffs, which are costing Americans a lot of money because it's the importers that pay the tariffs, not China. So Trump says that China pays the tariffs. China doesn't pay the tariffs. The people who import the goods, the Walmarts of the United States, pay the tariffs, and then they pass the price of the goods on to the consumers.
That is correct.
So it's not a good. It's not good. It's not good news.
No, Trump is bending the narrative to the way he that serves his self-promotion, and wants everyone to agree with what he's doing. He's leading us into a tariff war. Historically, there's only bad events that will happen through this. Typically, a move towards protectionism occurs a little later in the bear market when the economy starts truly to turn down. The nation or any nation suffering a recession needs to blame someone. They need to do something in Washington, and they start protecting industries. And of course, in an environment where our corporations have so much influence in Washington, the ones that will benefit from a move towards industry protection and tariffs, they're going to have very loud voices. And if you have a president like the one that we have right now, who is solely interested in his own ratings and runs the country like he ran his program, The Apprentice, you
mean you're fired?
Right. The tariff issue is something that just creates a lot of noise and serves a small special interest in this country, but this cuts both ways. Our exporters are going to suffer. Our agricultural industry is certainly suffering.
The farmers are going out of business. They needed a $15 trillion bailout, right? And I think they already got a $12 trillion bailout before. Because they're going out of business. They can't sell soybeans and rice and all corn and stuff.
A trade war benefits nobody, but it is very political. There's an appetite for this politically during a time where economic activity is withering. And Donald Trump has painted a picture of America of rotting, rusting buildings, a manufacturing infrastructure that's crumbling and falling apart. So this dream that he has that he's going to revive manufacturing, that's going to bring back the American dream, really is a fantasy. Manufacturing has become a smaller and smaller part of our economy over many, many, many years. And that is not going to be the solution to bring back American prosperity.
Well, I guess my question, my observation is, when Trump said he was going to impose these additional Chinese tariffs, the market dropped 619 points on Monday. Tuesday, Wednesday, and Thursday, it's back up. It's eliminated the drop, but nothing's changed about the tariff. So where is this optimism coming from?
It resides among...
and is it based on anything real?
No. It's all psychological. There's always going to... Human beings have an element of hope. They need hope. And hope is dissipating very slowly in this topping process. The narrative, and there's a number of things that have sort of slowed the process towards a recession and slowed the bear market descent. And that has to do with probably much to do with how the fiduciary duty was. What
does that mean? Speak English, please.
Oh, right. There was the Department of Labor back in 2016 passed a ruling that said investment advisory firms must adhere to a fiduciary rule and in treating their clients with appropriate types of investments. That liability that hung over the Wall Street firms was removed by Donald Trump early in his
Really?
regime. I think that was...
So it's like a moral code. Don't if the guy's 80 years old, don't invest in like a run of the mill like pet rocks, because it's not going to be a good investment in the long term.
That's one standard. There is a higher standard. The entire portfolio should not be subject to a catastrophic loss. So if you're doing your job properly as an investment advisor, you don't want to allow for the possibility of a sort of a ruinous collapse of a retiree's portfolio.
But you saying that now you can. They took that rule out.
Yes, they reversed the ruling about a year ago, mid 2017, or a year and a half ago.
What would be the rationale for removing it?
Increased sales. Wall Street does create quite a bit of GDP for the nation. If you do raise one of our capitalist system requires a constant feed of investment, whether it's into the bond market or into the equity markets, particularly into the bond market or loan market, and that has been really aggregated together into sort of the junk bond market has been coalesced into ETFs and other mutual funds, and those higher interest rate products are sold off to the retirees of America. And also equity issuance. You see Uber and Lyft and a number of these other companies get funding at the top of this market. Those are dollars that are going to be spent mostly through advertising dollars. Maybe some of it's going to be spent on Google or Facebook ads. But that does keep the economy going for in a brief little moment. It's sort of the fraudulent aspect of capitalism that's not really spoken about. All this very late cycle euphoria and raising of capital to sold under the concept that we're going to use all this money to expand plants and equipment, but really this is a cash out from the insiders. So Uber,
the money goes to the stockholders, which is why the market, why the stocks keep going up.
The initial owners of Uber, they're going to want their money out, and they want their money out at the top of the cycle. So this money going to those people allows them to, that does allow for increased GDP activity, because that money will be spent in one fashion or another, maybe buying $1 million homes and stuff like that. But this is the ending phase of our economy right here. I don't know. Did I answer your question?
Sort of. You kind of went on a tangent about fiduciary.
Oh, right.
But I guess the question was where did this optimism come from for the market to recover in 3 days when nothing has fundamentally changed? The China tariffs are still coming, or they're in place, or they're coming. The farmers are still going bankrupt and they need to get bailed out with a $15 trillion payout from taxpayer wallets. Nothing has changed that the market should recover.
There's
in 3 days, nothing changed.
Back in March of 2009, you could say that there was a low point for optimism, and optimism has grown since then, and it grows, and it hits its peak level of optimism at the top of the market, and then as the stocks decline, so optimism dissipates. Hope, I like to say, hope dissipates, but there's always going to be a residual level of optimism here, just because people don't change their minds very quickly. I was just going to say something, and I just lost my train of thought.
Well, people don't want to lose money by bailing out of the market.
Well, there's a...
Because then the market goes up, and they're like, I just, why did I bail out of the market? I should have just stuck in for the long haul. Because that's what they say.
Yeah.
That, if you stay in for the long haul, 96% of people who stay in for the long haul win.
I saw those commercials on television.
Yeah.
Those are awful.
That's not true.
Tell that to the person in 1929 who had his retirement savings in the market that he should have held on. Or how about in 2000? You had your money in NASDAQ. You believed in the technology fantasy of that day. Mm-hmm. You wouldn't have broken even until, on a nominal basis, until like 2016 or 16 years later. Mm-hmm. The optimism, it's an endogenous process. As the stock market bounces up, people's optimism will reinflate. As it falls, it will decay. And at some point, there's going to be a decline, and then it's going to be followed by another decline. And this is what happens in the ferocious part of the bear market. There's a persistency to the declines, where each decline then causes more people to abandon the hope that we're going to have higher prices, and then they sell. But at the top of the cycle, it's like water in a process changing into ice. So you have a few molecules that are in water form, and they all of a sudden become ice molecules, and then a few other become ice molecules, and then they change back to water molecules, and then they phase change again into ice, and they come back. And this process can go on for quite a while, but eventually all that water in one moment moves over, it hits a critical state, and it all moves to ice. And the process goes in reverse also. But also the state of mind of the herd, the crowd, it has a contagious optimism that won't let up, even in the face of the most logical, analytical reasons why they should give up hope. People are very hopeful. You need to be
gullible, right?
Yes.
Might be a better word. Because what they're saying now is that everything's different. Like, oh yeah, well, in the past we've had booms and busts, but take a look at this recovery. We've been in a bull market for 10 years. It's now the longest bull market in history. Like, they totally discount that we had any kind of a bear market up to now. And, it's never going to crash. So put your money in, because, in 2021, 2022, it's going to be up another 40, 50, 100%.
You would expect that kind of, conversation on television at the top of the market. At this juncture here, where things become very fragile and valuations move into the extreme, in this case, the most extreme level of all time, you need the cheerleading to get intense, just to keep the complacency in place. You don't want, and the people who are on television, they think they have a virtuous job here. They think that they can continually, abate any collapse that happens in the financial markets. They think that there's some external cause, that if someone says the wrong thing and that person maybe has some missionary status, like someone today who had the status of Alan Greenspan came on and said, oh, this thing is going to collapse. Everyone would hear it. And in that same moment that everybody's sitting at home watching on television, they hear this person say that, they also realize that everybody else heard that. And then there becomes a race to sell. And those kind of panics happen. Those types of panics do not happen in the middle portion of the bull market or in the beginning. They happen only at the top. You can only have an avalanche when the mountain is completely covered with snow. Once the avalanche happens, climbing that mountain is no longer a risky thing to do.
That's an interesting analogy, yeah.
And so we sit right now at a mountain covered in snow, in the most fragile state, and everybody on television is unwilling to talk about anything in an authentic way. Like,
avalanches don't exist, according to the...
I find it fascinating that world trade is down at the abysmal levels of 2009 right now, and there's no conversation about that. The image that I have in my mind, which I think is so appropriate, is Wile E. Coyote when he is run over the edge of the cliff, and there's only air beneath him, and his legs are spinning, and he hasn't looked down yet, but then he looks down, and he realizes that there's nothing supporting him, and he falls. That's how investors are at the top of every single, bull market. They're not looking down. They're not aware of how expensive the market is. They're not aware that they're at peak earnings and that earnings do decline because margins are mean reverting, and you can't price assets into the future based on the highest print in 10 years. The recession is something that's good. You need a recession to purge the system of all the rotten corporations, and there's tons of rotten corporations today.
But there's also there are types of corporations that they lose money initially for years, but eventually they turn into the black, and then they start to be very popular. I mean, sometimes it takes a while for them to catch on. Like, for example, I want to say I think Netflix makes money now, especially since they don't pay any taxes. That's very helpful. But for years they ran at a loss, right? And I think now they're just beginning to make money. And in the future, I personally have Netflix. Everybody I know watches Netflix. I think Netflix is going to be around.
Yeah, I think that Netflix is going to around, certainly because Disney might want to buy it. The thing is, what is Disney? What is Netflix worth? And it becomes, what is it? It doesn't become anymore. What kind of earnings can it generate? Because obviously there's tons of competition, and Netflix does not have a moat around its business. It does have a fantastic brand. Disney does recognize that, and they expressed interest in buying it. But the question becomes, what do you value Netflix at? Well, if Disney is thinking about buying it, then you slap an absurd price on it, one that Disney won't be willing to pay for. Now, that doesn't mean that Netflix is actually worth that, but that's how people are thinking about it right now.
Well, I'm old enough to remember when the value of a stock was based on its future earnings potential by some kind of a multiplier.
Yeah,
like 6 times or 8 times future earnings, and that would be boom, $32 for that stock. Now it's like stocks like Uber, which loses tons and tons of money. I think you're getting a phone call. Is that what that is?
Oh, Jesus.
It's got the what is it? $9 billion valuation.
Oh, what Uber? You're saying?
Uber has got a $9 billion valuation, and it loses money. It doesn't make money. And the people the drivers say they're grossly underpaid. They're all on strike.
Right.
And it's not a multiplier of future earnings by 6.
No. Companies like Uber, and all companies that go public at the top of a bull market in a media euphoric environment that's worked up on behalf of the investment companies that want to take these companies public. There's a lot of money for the advertisers. For like CNBC and Bloomberg and all these companies that sort of feed at the same trough, and they all will suffer a loss of earnings in the decline. So they're all on board cheerleading all these stocks higher. Uber does not have a moat around it. It has an app, and that app could be replicated by anybody.
Well, Lyft has the same app.
It is, and these are the worst part of this fantasy says that Uber is going to be, or Lyft, or people think that they're going to be wonderfully profitable businesses, but they haven't been able to demonstrate that their economics are any better. And in fact, it looks like their economics are inferior to the old limousine taxi companies.
Right, taxis make money.
And they're very competitive as well. The Uber is just another person to feed at the trough, and there's no moat around their business.
What about Beyond Meat? This is one that I know I talked to you about a lot, because Beyond Meat has been up, 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 irregardless of if the market is up or down. The market's down 619 Monday, Beyond Meat's up 5. The market's up today 300, Beyond Meat's up another 5. I mean, Beyond Meat seems to be beyond reproach. I mean, it's like, how can you lose money putting money? You know, if it's always going to go up, then why not buy it?
Well, one, I think their financials say they only made $80 million.
They lost.
They sold. They had sales of $80 million last year, and of which they lost $30 million for their early investors.
Yeah.
Now, the fantasy here.
Their net loss 30.
The fantasy is not that the product is bad, because the product is really it tastes well. It's remarkably similar to real meat, although you could tell that it's not. You would be happy eating one of those burgers for the rest of your life rather than eating a regular hamburger.
Steak.
And so the product is fantastic, but they have not demonstrated that they can go through a full cycle. How are they going to handle the recession that comes? They do have now. They did raise a lot of money at the top of the cycle. That's going to carry them through for a number of years. Allow their whatever arrangement they make with their food processors or the people that actually make these burgers for them and the other meats, those
distribution. Yeah, they have problems with their distributors.
Yeah, and those
the purveyors.
Is that what they call them?
The people that provide them with the raw goods.
They get a lot of stuff to work out.
Yeah.
Eventually there's going to be a market for that. There's definitely was a market for the internet, but in the .com area, every single company out there was promoting itself as the solution to all the to everything. There's internet companies that were going to do everything for us. We were never going to have a bust again, and those fantasies are most sellable at the top. And if you're going to sell part of your company, you want to sell it to investors when they're in the mood to open their wallets in the biggest way possible. And at the top of the cycle, where wealthy investors are just aching to put their money somewhere, that's when you want to hit them. And Beyond Meat is they've been advised very, very well. They sold and they raised capital at the top of the cycle. For an advisory firm,
they opened well, had a good time.
Yeah, they did. This is when you want to take your company public. Now, as an investor, I like the company, I like its product. Let's see how it handles the bear market and the recession. It's trading at what, $90 a share now. These things do fall quite substantially.
And I opened it like half of that. I mean, I'm not sure, but it's just meteoric. And it seems to be Teflon. It seems to be irregardless of what the general market's doing.
Once this
maybe it's a good flight to safety.
No. Once this. There's two issues in investment management that I have to grapple with, and I tell my clients all the time. It's what to buy, which is one issue, but the more important question is when. When to buy it, when to sell it. So there's plenty of companies out there that I would love to own, but it's just getting them at the best price possible. You don't want to buy it at 90, it falls to 70. Do you want to buy it at 70? Why don't you just wait until the whole thing flushes itself out? Bear markets take quite a while, and they usually end in a big boom bust where everything goes down. And in a bear market, 9 out of 10 stocks are falling over the long towards the bottom of
all the boats rise or fall with the tide.
Yes, and the tide is at the top right now, both literally and figuratively in the stock market sense. And I say literally because the tides are very high right now off of Battery Park.
But if you watch the pro business, because I'm CNBC, Bloomberg TV. They say, hey, earnings, we just had a fantastic first quarter. Revisions are up. This company was expected to make 2.4%. It made 3.3%. Unemployment is low. Everybody's got a job. People can afford to buy things. I mean, how is that not a smoothly running economy that we should have to worry about the stock market.
These are all the statistics that occur regularly at the tops of the cycle. Unemployment, the unemployment claims number, that hits the lowest level possible at the top. And it actually marks the top. Once we start declining off the top, initial unemployment claims rise. And you would expect that. Even the average person thinking about it understands that there was a recovery that began in March of 2009, and as that sucked in unemployed workers, more and more people are employed, and then it gets to the point where businesses overexpand their employment, thinking that the expansion is going to go on forever. They make this mistake every single time. So the low point in the unemployment claims occurs at the top. That's normal. On television, they will use that as an indicator that everything is good, but a student of financial history understands that, that's one of the most important indicators that the top is here. And you don't need to wait for that to turn either. It will turn, with a slight lag, but there's a lot of up and downs in that initial unemployment claim number. But, in the bear market, you will see it leap. Claim numbers will leap upwards. I think at the worst point of the 2008 and 9, we were talking like 1 million people laid off. The claims numbers were humongous, and they came right after the all-time low print at the not the all-time, but the print for that cycle was the lowest at the top, and then it just collapses from there. The other items that you mentioned, GDP came in at 3.2%. There was a large inventory restocking.
That's a good number, isn't it, by any argument?
No, the GDP is actually a number that was created around after the Great Depression in World War II to keep track of production. It's really not a very good number measuring economic activity. The Department of the Bureau of Economic Statistics has another number that is not widely publicized. What's
that called?
Gross national output, or gross of, that actually has a better track record at showing turns in the economy than
But more accurate reflection of what the economy is doing than GDP.
Yes.
Okay.
There's also a very interesting thing going on with the inflation number right now. The real GDP number, which is 3.2%, that's real GDP, and you get to that by taking the nominal GDP number and then subtracting from it the inflation rate or personal. There's a CPI number, and then there's a personal consumption expenditure number too that deflates the nominal to the GDP, and that inflation number has actually been very, very low. So if you look at nominal GDP, you're not getting a jump in that. What you're getting is a decline in the rate of inflation. And many years in the future, or a few years in the future, I'm going to be interested in see what kind of revisions they have to these numbers right now.
Yeah, they always revise backwards.
Also, first quarter GDP had tons of Pentagon spending in it. Personal consumption by households is actually declining. So, second.
I thought I read somewhere that people are maxed out on their credit cards right now.
They are.
They never have been before, and that auto sales are defaulting. What do you call it? When the loans on autos are defaulting at a very, very high rate.
We have delinquency on auto loans at a rate already at a rate that is very similar to 2009 already. I mean, when our central bank lowered interest rates, it made financing of autos very affordable. So people can get a BMW at 0% financing. You can, buy something for $300, $400, $500 a month on a
Correct.
3-year lease.
Right.
And that really took forward a lot of auto sales from the future, pulled it into the present. And it makes complete sense to me that Ford and General Motors are now like, are abandoning car production. They're going to go with the light vehicle and SUV vehicles into the future. Maybe they'll hold on to the Corvette and the Mustang, but
Well, the Mustang definitely. I think that's the #1 selling car in the world.
is it?
Might be. It's a very popular car. Everybody loves Mustangs, including me. I
Yeah.
never had one, but I love them.
Yeah, I like them too.
Yeah. So, what about the buybacks? Buybacks are like $3 trillion this cycle so far. I read somewhere. That's a lot of money. $3 trillion in buybacks, and all the money goes into the stock to push the stock up. And I think this is manipulated. I know you don't think that it's that big a deal, but
Well,
I think it's a
happened.
major manipulation of the market. Every time that, like that, I'm sure on that 619 down day, the companies bought themselves, $300 million worth of stock to boost it because they got all this extra money from the tax. They don't pay any tax anymore with Trump.
Yeah, at every cycle top, you have buybacks become. It's to achieve. If you were a CEO and you're on that C-suite, you're chief financial officer of a large corporation, your compensation's tied to your stock price,
Right.
or some metric that's really tied into your stock price. So the most direct way to move your stock price up is to buy it yourself. So buybacks were very big during the 2007-8 period, as well as the
lead up.
99, 2000, and they peak. They peak right at the time of the market top,
They're
or
peaking
maybe
now.
shortly thereafter. But they then dwindle because in the collapse that occurs, the recession that follows, sales are down, cash flow is down. They got to conserve, and the bond market was not so willing to, hand over its funds sight unseen to what a corporation is going to be doing with it. At the top of the cycle, they don't really care if they're using the proceeds not to, to expand production of their plant.
Or research and development.
Right. They don't care that it's just going into buying back their stock. However, in the recession, bond investors get more nervous. They become much more finicky on where they're going to lend their money. So borrowings for buybacks stop. And as you would expect when belts get tightened. And so this, activity that's sort of buoying the market here. And it's not as much as people think. The dollars are humongous, but any given day, we're talking, single-digit % of the trading activity going, even, we're talking about 5% at the most.
You talking about volume now?
Yeah. So
has volume been high or low in recent weeks?
no, it's actually low here. We're in a cycle top. We went to the December 26 marked an intermediate low bottom. Swing low, and then it bounced out of that, and the volume was high, and it's dwindling now. This is very low volume right here at this turn. So on April 23rd or 26th, depending on the index, you could see sort of the lessening of the volume of shares traded on New York Stock Exchange.
So in a bear market, when you see a heavy volume, it's probably because they're selling.
Well, there's going to be, yeah.
You're not going to see a whole lot of huge peak of buying in a bear market.
Yeah, there's going to be high volume down moves, very very high volume, especially among the panic free fall stuff. When everyone drops their orders, they want to sell. They're going to do that. The herd is going to do that in unison, and you're going to have opening ticks down 1%, like we've seen recently. I think Monday we opened down like 100 or 150 points. Right. And the sell orders are going to overwhelm the buy orders. The buyers are going to, have a bit of nervousness as they see the market falling, or maybe they put their money to work thinking they're going to catch a quick rebound. Bear markets are no fun for 99% of the investing public.
Is there? I'm not sure you know the answer to this question, but what is the percentage of money that's in and out of the market on a daily basis?
No, we're talking very small. Of shares outstanding, we're talking 1-2%.
Day traders that buy in the morning and sell in the afternoon.
All the activity is amounting to, you were talking about single digits, 1, 2 maximum.
So they're not going to spook the market if they all sell at once at 335.
Well, if there's
because it's only 10% or 5%.
If there's no one willing to to be the buyer at a price point that is around where things are trading, it could just fall. Remember, each one of these prices everything is getting priced every single day by only a few, very small percentage of shares being traded.
Right.
Nixon called it the silent majority. There's a silent majority of people just holding on to their positions in their 401k or doing no thinking whatsoever about what's going on.
I know lots of people like that. They trust their brokers to take care of it.
And most of these investment firms, in their disclosures, full disclosures, they say that they don't advise on the market cycle. That decision is left up to the individual to be in or out.
Well, they typically ask you, how much risk do you want to take? Do you want to take, moderate risk? Do you want to take high risk? Do you want to take a low risk? And then they invest accordingly. Is that not true?
Yeah. It's like one shoe fits everything. That's not really how you should. It's not how I operate a firm. Not how the best investors of all time have operated. At the top of the cycle, you want to take as little risk as possible. If you are adventurous and risk-taking, you want to start start adding some shorts to the portfolio or explicit bets that the market's going to go down. But you want to have, at the top, you don't want to have any exposure. You don't want to suffer any of the losses that are going to befall on the shareholders. There's going to be bad people. Right now we have.
You mean holding the bag?
Holding the bag.
Those are the bag people?
Yes, the ones that I guess in the criminal world, they're the ones that go to jail, and
the fall guy.
The fall guy. In the investment world, it's the people that were sort of sucked in by the enthusiasm at the top. They're
optimistic.
They are probably the ones that weren't even engaged in the process from the beginning. They now it seems to be super safe. And the Wall Street firms that are on television have pulled out all stops on their optimism because this is the last moment. This is where you get everybody in that has been on the sidelines to get keep this price bubble intact. And, those become those are the ones that hold the bag on the down move.
Why can't the market say, okay, look, right now we're telling everybody not to invest in stocks. The market is
the whole thing would fall
overpriced.
apart.
So be careful with your money right now. Take put a bunch of money under your pillow, and you'll thank us later.
Yeah,
they don't say that.
Of course not. In past year, there's back before we had deposit insurance in the banking system. The most frightening thing for our banking system was a run on the bank. So if someone, and this is a true story, back in, I can't remember what year it was, I think it was 1906, there was a sandwich stand, a restaurant selling sandwiches right next to a bank, and there was a long queue at lunchtime as all these construction workers lined up to get their sandwich. And some journalists saw that and reported that in the afternoon newspapers, that there was a queue outside of a bank. That caused a run on that bank.
When it's actually a queue up for sandwiches.
And they were queued up for sandwiches. And so everyone's very careful to you don't they fixed the sort of the bank problem by having FDIC insurance, but you could have a panic and a flight out of securities in the securities market, and it's going to and when it happens in the world that we have today, it's going to be a global phenomenon. And it has been in the past a global phenomenon. Mm-hmm. In 1987, all the stock markets of the world went down simultaneously. Not only did the United States go down, and I think the attribution was computer program trading in America, but Hong Kong crashed even more so, and there was no computerized trading there in the European markets, so fear is contagious among our species, and we don't even need to speak the same language or have the same culture. We have a very globally connected, not only economy, but our hopes and desires and beliefs and fantasies that we all have are all woven together. So right now we only have the U.S. market that is situated at the top, which is the third peak in this triple top. Right. And it's the indices that are heavily tech weighted that are that are actually at these levels.
Yeah, the Google, the Apple, the Netflix.
That is the only
Amazon.
In that resides the remaining hope that this bull market will continue into the future. And it's been 15 months, and we still haven't been able to materially move past the first of the peaks, which is January 26, 2018.
And that's significant.
It is. This is a triple top. This is, plus we're at the most overvalued market ever.
Now, does this work on the downside as well? Like let's say I mean, I've heard you say that the market could go as low as 10,000.
Sure.
So if it bounced 10,000 up to 15, down to 10, up to 20, down to 10, up to, then that would establish that 10 is the benchmark. It's not going below 10.
We're not going to know. We won't know until we get there. But the bottom is going to. I've looked at, and if you do what I do for a living, you really want to look very closely at all the bottoming prices. Mm-hmm. Processes throughout history, and and it doesn't matter if you look at the U.S. markets or European or Asian. Human beings display the same behaviors as groups in the stock market or any market whatsoever where there's an auction for securities. They will panic sell at the bottom. There will be a final moment where the hope completely dissipates and everybody gives in, and that will create the moment of that creates the possible moment of a bottom. Now, a bottom could be a singular bottom, but it usually will, hit that bottom and then repeatedly test it by going down and possibly breaking through it, going to a new level, and then testing it again and testing it to the point where the final test actually bounces off this low point, and then maybe it'll go down again in a ferocious way and test that point again, and that that's how a bottom is put in, and it will occur with a complete exhaustion of selling activity. Everybody that had was suffering.
You just want to save whatever you got left.
Okay.
Right? Your money. I mean, you want to save whatever you got left.
Yeah, you do, right?
At a certain point, your optimism goes away and you become a pessimist.
And then you sell.
And then you don't want to buy.
And they tell you to sell on
blue-chip
television
stocks.
too.
Yeah, and you
They'll-
don't want to buy blue chip stocks because you just lost a fortune.
If you watch television, they'll be telling you to sell. All they're going to do is reflect back your misery and utter pessimism to you. And
You don't
that
have to,
will,
wait a minute, when it's at 10,000, you don't think Kramer's going to be saying now this is time to buy into this market now? This is like way oversold?
no, he's going to be telling you to buy in through the first half of the bear market.
Right. Buy on the down when it's
Yeah,
going down.
he's serving his masters. His money is made by, coming from, he's there because Morgan Stanley, Merrill Lynch, all the investment firms want him there. He's part of the tool, part of the apparatus that gets all the bag holders to buy these securities at the top.
We only have like 10 minutes left, believe it or not, but I want to ask you about the government spending, the deficit, because the United States seems to be, the world economy is in shambles, basically, is what you're saying, but the U.S. economy is good.
No, it's not good. It's just because Donald Trump says it's good and people on Fox News says it's good, it's not very good.
Well, it's better than other people, other economies.
Yeah, he could probably say that. I mean, the optimism hasn't abated yet, and the stock prices haven't fallen. So the banking system, well, not the zombie banks, but the lenders are still have access to cheap credit. So if you are a company that needs to borrow more because you want to buy back more of your own stock, you can access the bond market. Spreads are still tight. I mean, they did sort of look like they were going to blow out in December of 2018. And each time the equity market does crack downward, lenders become very, very nervous to and hold back on releasing their funds. No one wants to once this thing breaks, the credit markets just turn off.
Well, I remember the spigots were turned off in, what, 2008-9?
Yeah, it happens very, very fast.
Yeah.
There's no slow process to this. And the signal, everyone's going to get the signal at the same moment, and that signal is the drop of the Dow or the S&P 500. A serious drop that's going to scare the bejesus out of everybody, including the bankers.
Mm-hmm. Well, I think they're saying that the Fed is going to drop interest rates.
Fed can't drop interest rates right now.
But another up for the
Yeah, this is what really makes this is awful how they present this whole issue. After 2009, the Federal Reserve decided that it's going to pay interest on excess reserves to the banks. So the banks now have about $1.5 trillion sitting at the Federal Reserve that they're actually getting 2.25%, 2.5% interest on. That is a direct subsidy to the bank, and the Federal Reserve does not want to lower that because that's the lifeline to them. When their loan book blows up in the next recession, they need a way to funnel money into the banking system, the large banking systems which operate as a transaction system for the economy. They're not going to let these big banks go down because the role that they serve is paying the checks and the credit cards for the nation. And it also allows some serious surveillance from the federal government. So they encourage this consolidation from a security standpoint, and they ensure the solvency now by paying interest on these unused reserves that sit there. So what they're going to do is try to keep rates as high as possible to funnel money into the banks, and then eventually when the screaming by Donald Trump gets too loud, they will be cutting rates. But they're going to cut rates, and it's not going to revive the economy.
But that's what they would do if the market were to drop, let's say 10,000 points.
Back in 2000,
they would cut their interest rates. Right?
Yeah, back in 2007, they started cutting in August of 2007. The top was in October of 2007. They continued to cut, and that didn't prevent a recession. Certainly didn't prevent.
But it brought us back, didn't it? Help revive the economy?
No, this is before the plunge. They saw the plunge coming. They told everybody that the subprime problem was contained. They started cutting rates in August of 2007. They dropped rates down to zero when basically probably seriously started cutting when Lehman Brothers collapsed. And you can't cut rate. Once the speculative urge dissipates, no amount of cutting rates will revive that. We have a speculative mania right now that could only wither. That optimism from this point cannot withstand a very long period of time. It starts declining. Optimism grows, it's born, grows old, and dies, and just like our economy. And no amount of cutting rates can revive optimism once stock prices fall. People will want to go to cash, and they won't care that their cash earns them nothing. The cash just won't. Cash isn't, your cash doesn't fall from 100 cents on the dollar. It stays 100 cents on the dollar.
But you're not always a market bear. I mean, you're going to be a market bull when the market drops. You believe in the stock system.
Oh, yes. This is the system that we have.
It's not completely corrupt.
No. This time around, the urgency to the importance of keeping people invested right now is because the idea is you want to socialize the losses to the greatest amount of people. You don't want any, and the federal government wants to, protect corporations from their bad investments. So from our government's perspective, they want to keep the employers in business. And they want to allow them to have enormous piles of money that they borrowed. They want stock issuance so that there's ample funds there for these firms to, weather the downturn. The problem is they're squandering all their money on buybacks. They didn't use any of it to create plants and equipment to lower their cost of production. And there's so much corporate money going into, lobbying Washington, D.C. So all these good intentions that all our policymakers have, they're all corrupted. At the end of the day, every policy becomes corrupted for the short-term profitability or interest of the people the agents that run the large corporations here in America. And the system is not different anywhere else. I mean, Europe has its socialist model that also has an enormous influence coming from the corporate sector. Anyway, it looks like we got to wrap this up.
Yeah.
And
so what's your advice, real quick, for people right now?
Well, don't buy into this optimism. Take profits. The money that's going to be made by the smart investors are going to be the ones that hold on to their cash and deploy it near the bottom. Mm-hmm. That's what I've told all my clients I'm going to do for them. You don't want to get caught here and have your wealth destroyed before the great opportunity. If you want to give me a call, I could talk to you further about this, and that's really what you want to.
Let me put the website the-money-game.com. So if they click that, I'm sure they'll be able to get a phone number.
Actually, is not up and running yet, but my website is clearwaterinvest.com.
Okay.
I'm having a new website built, and it'll have that URL linked to it, but not yet.
Perfect. All right, man. Well, another great show, very informative. Thank you.
You're welcome.
And we'll see you in 2 weeks.
2 weeks.